Now, we've got Ashok Kumar, who's one of the analysts who's been covering Cisco for quite a long time and really has an understanding of what Cisco's been going through and how the company is changing. So when you look at the way this company has changed, Ashok's at Rodman Renshaw now covering the company, but you've been covering it for a long time, since before your Rodman days, Ashok. When you look at Cisco today, what do you see?
Cory, I think you raise a very important point in terms of the stock performance. Today, the story is essentially abandoned by institutions, institutional investors, large and small. So the growth investors, abandoned the story a long time ago. And today, the operating model has not stabilized yet to be attractive for either the value investors or turnaround investors. So it's essentially a story without a home today. As you pointed out, and Emily pointed out earlier, I think there are organizational issues that need to be fixed. Over the last business cycle, the company was structured in terms of fiefdoms, decentralized, with divisional managers essentially given a lot of authority and very little accountability. And I think Chambers is going back to the original structure, which is a top-down, hierarchical model, which will place, more responsibility and accountability at the top. So I think there are some changes that are happening. But the bigger issue now, I think, Cory and Emily, as you pointed out earlier too, is, structurally increased competition. So the company has very little control in terms of the revenue growth profile as well as gross margin. So the only thing they can do near term is, focus on realigning the cost structure with the lower growth, trajectory.
Ashok, I mean, you talk about a story without a home. I mean, that's, we talked to John Chambers earlier today, and he talked about the notion of investor confidence.
Absolutely, and I think the 12 to 17% growth that the company had laid out for quite some time, the investors have come to view that for a long time as unattainable. So having taken that off the table, I think the first step in regaining credibility, and also related to that is stop pursuing this value-destroying acquisitions. Right, as you pointed out, Cory, I think the company has been a serial acquirer. And none of these acquisitions have amounted to much in terms of bottom line and top line contributions.
Yeah. Well, Ashok, let's listen to what John Chambers had to say earlier today on Bloomberg TV.
What we're going to do is earn our investors' confidence one step at a time. We delivered this last quarter what we said we were going to do, a little bit above. We re-level set for this next quarter, because as you make the changes in terms of organization structure, as you take $1 billion out of your expense run rate over the next several quarters, which will be done largely in the next 120 days in terms of the people impact, that's going to slow your business for a period of time as you do this heavy lifting behind the scenes.
Yeah, so Ashok, you hear him talking about that, cutting people and the effect that has on the company. Morale at this company is pretty low, yes?
Oh, absolutely. The headcount right now is about 73,000. So the positives are, the revenue per employee is still about $600,000. The operating profit per employee is about $160,000. It's still pretty attractive. The company throws out about $7 to $8 billion in cash per year. But as you said, I think it's been mismanaged through this whole cycle. And as such, the only item they have under control is operating expenses, and the only way they can fix it is by reducing headcount.
Well, and again, about the morale issue, I mean, you and I both talked to Cisco employees, and adding layoffs on top of already unhappy people isn't going to help you turn around the ship like that.
No, absolutely not. So I think, at the end of the day, all your assets, walk out the door. And, given the level of backlash, within the employee ranks, I think it's going to be a long time before the ship rights.
Yeah, now, really quickly, I want to get another soundbite we've got of John Chambers talking about what businesses are working and what aren't at Cisco. Let's listen to that bite right here.
Our routing products are in very good shape, and I think you saw that growth at 7% this last quarter. So good balance overall, but we're clearly getting hammered in the public sector, and that's an area we've got to realign our resources and focus on cloud and collaboration. And the switching side, we're getting a lot of good competitors and therefore very low growth.
All right, Ashok, your thoughts on Chambers' comments?
Yeah, I think, Cory, one is they have very large, public sector exposure, 20% of revenues, which has historically been a very high profitability segment. So that's going to be under pressure for some time to come. Now, in terms of switching competition, I think that's the core of Cisco's problem. On the enterprise side, the company faces structural headwinds in terms of very aggressive competition from Hewlett-Packard. On the service provider side, from Huawei as well as Alcatel-Lucent, and none of that is going to go away. So that's one of the issues the company faces. Very little control in terms of revenue growth as well as gross margins.
Yeah. All right. Ashok Kumar of Rodman Renshaw, thanks for joining us.